Hey guys, welcome back to a new episode of the ThoughtfulLeigh podcast. Believe it or not, this is episode 4. This is a long way to go and a cause for celebration. Yes, I know people typically only celebrate for when it's 100 episodes, and are we at 100? No, we still got 96 more to go, but 4 is still a huge accomplishment for me, so yay, thanks for staying around with us as well. So for today's episode, I kind of like to start this podcast off with what I'm going to call the procrastination corner, where we kind of talk about cultural stuff before we get into I'm going to say instead of meat of things, because I don't love that phrase. We're just going to start saying the main entree of the podcast. And so for today's cultural stuff, we have the World Cup qualifiers ended, and we have some surprising or interesting stories where we have Scotland, we have Curacao, and we have Haiti, and they all kind of blew up my Instagram feed. So that's all exciting news for those countries. And then moving on from football. Hey guys, this is Editing Leigh. I had to review this section of the video, but Bad Bunny kicked off his global tour in Santo Domingo, República Dominicana, and he brought out Romeo Santos for a bachata version of Boquete. How cool. Was not expecting that. Definitely waiting for that to be released. Alright, see ya. So that's the procrastination corner, and now we will get into the main entree of today's podcast. So before we go into what we'll be discussing today, so we'll be covering the Fed FOMC meeting minutes for the October 28-29 meeting. And then we'll also have earnings of TJX, which is parent company of T.J.Maxx, Marshalls, HomeGoods. And then we'll be discussing Target and Walmart earnings as well. But before we do go into this, I am stating that I am not a legally licensed financial professional. This is not investment advice or recommendation, but rather informational, educational content, since we like to learn and grow together. And with that, let's get started. So the Fed, or Federal Reserve, Fed's for short for Federal Reserve, had their FOMC meeting on October 28th through 29th. The FOMC, for those who do not know, stands for Federal Open Market Committee, and the FOMC is the committee within the Federal Reserve that is responsible for setting the federal funds rate, or I guess you hear in the news a lot what people call it the interest rate. And so they released their meeting minutes for this October meeting, where again in the meeting, as a high level, they did announce that they decided to reduce interest rates or the federal funds rate target by 25 basis points, or 0.25%. Specifically in the meeting minute notes, I did want to go over a few things that they talked about during this meeting, it appears. So before this first point, the Federal Reserve, they do kind of believe that they have two mandates, which is they want, in terms of setting monetary policy for the country, the U.S., since it's for the U.S. The first one being optimal levels of employment, and then the second one being an inflation target or goal of 2%. So with that knowing, they did state it looked like total consumer price inflation for September was 2.8%, which is higher than their 2% target goal, and they're stating that this implies that inflation did rise by 0.5% from this time last year. So they're seeing inflation, I guess, of a year-over-year perspective is increasing. For public equities, that's your stocks. In other words, they, in terms, are seeing, one, they noted price per earnings ratios. So price per earnings ratios, or PE for short, as you'll see people say. PE ratios are really important for we'll use these two companies since we're talking about their earnings later on. Again, I'm not recommending investment advice here. This is just for informational purposes. But let's say theoretically I was interested in buying stock in either Target or Walmart, but based off of their share price alone, I don't necessarily know which one is the most expensive company out of the two, in terms of valuations. So you would use a PE ratio to compare the two. So let's say, and theoretically what you're doing here, you're dividing the share price divided by the earnings per share that this company is having. That's kind of just a value metric to kind of compare different companies off of each other. And you would say kind of the higher one would have the higher valuation. But again, that's just one point of consideration when considering how a stock is valued compared to another one. But they're seeing here that PE ratios were on the higher end of the historical distribution, aka they're just saying that stocks are overvalued compared to what they historically have been. in my layman's terms of putting it. And they also said they do see like the increase of newly launched leveraged exchange traded products to further reflect increased appetite for risk. So kind of to explain this point a bit more, I will kind of use this like an example. So like for the NASDAQ is an exchange. I do want to put like a video explaining the different exchanges that the stock market has. So like when you think of the stock market, it's just like the broad umbrella of it, but there's different exchanges that these companies can list onto, and that's where they're being bought and sold. And so the NASDAQ is one exchange that companies can list onto. But when you're wanting to say that like you want technology, broader technology exposure, you wouldn't say that like you want to buy the NASDAQ, because like the NASDAQ isn't necessarily something you could just buy. Similar to the S&P 500, it's kind of just like an index. You could get an exchange traded fund that can help you mirror what this index would look like, or performance in this index would look like. And so like the QQQ is an ETF for like the NASDAQ, kind of just representing like if you had exposure to the NASDAQ. But there's actually versions of the QQQ where like using leverage, you could get 3 times what you could get for the NASDAQ. Or there's one where like if you had an outcome where you felt like the NASDAQ, prices within the NASDAQ were going to fall, or as people would say, like you want to short the NASDAQ. There's a leverage ETF product where like you're shorting the NASDAQ. So like they're saying all this like usage of leverage for these ETFs, like they're seeing this, and with although like PE ratios are still really high, you're seeing like hot market activity, that there's increased appetite for risk on the market right now. So in addition to that, they did talk about some uncertainty that they did see in the economy. Specifically, they saw the cooling labor market. They saw inflation, as we discussed earlier, with this 2.8% number in September as still being above their 2% target percentage. They also saw uncertainty being caused by government policy changes and the impacts that could have on the economy. They talked about tariffs, and in terms of like, I talked about in some of the previous fashion earnings that were in the podcast before, where you're already starting to see companies raise prices and pass through the tariff costs to the consumer. There's uncertainty about what that is going to look like. And also, another point I did want to talk about in that the Fed and the FOMC meeting minutes didn't talk about this, but in their beige book for October did talk about this, where some districts are already starting to see labor shortages due to immigration policy. And specifically, they talked about this being in the hospitality, agriculture, construction, and manufacturing sectors. So this is another area to look out in terms of how government policy is potentially impacting the economy. And then they also said limited data due to the government shutdown. The government has since reopened since this meeting, but during that time, the labor numbers from the BLS and then also like CPI was not being reported. In terms of inflation, so as I mentioned earlier, they kind of talked about inflation due to tariff pass-throughs, but then some participants, they did raise a point in terms of AI and automation as potentially being mitigants to inflation, or the pass-throughs caused by the tariffs for inflation. This is an interesting point. It will be interesting to see in terms of if some companies are saying that, like, you know, based off the efficiencies we are gaining from AI and any automations from like technology or whatever, if that's enough to cover not passing on tariffs to our consumers. But then, however, there are already companies that have passed through the tariffs to consumers. So I wonder if that's going to be kind of like a peer pressure from other companies to say, well, company A is already doing this, like we might as well. I do think if you start seeing people or companies start reporting that they have higher profit margins because of the tariffs, if that's also maybe going to make companies rethink their pricing strategy because their competitors are having higher profit margins, so maybe they think that they have to report higher profit margins to their shareholders too. But then I think also at the end of the day, it depends on consumer pushback in terms of if consumers are going to push back on this. The luxury fashion companies, they didn't get pushback from their consumers, so they were able to do the price increases. But the beige book for October did also state that like some companies specifically decided not to pass on the tariffs because they were worried about that consumer pushback. So that's something that for the later months to continue to look into. The last point for the Fed FOMC meeting that we will cover here is that they noted that there could potentially be consumption growth vulnerability if high income spending did weaken some. And this is a good point because the fashion companies, the luxury fashion companies, they did all report kind of higher numbers per se. I'll continue to look out for the luxury fashion companies, the hotel, and then even the airline companies to kind of see like what their gauge on the higher income consumer is. But that is a good reminder of something to look into. So that was the Fed FOMC meeting minutes. So now we'll go into TJX earnings. So TJX, which is again the parent company of T.J.Maxx, Marshalls, HomeGoods, HomeSense, Sierra. Sales from Q3 fiscal year 2026 were $15.1 billion, which is up 7% from Q3 fiscal year 2025. The CEO had stated in his remarks that sales, pre-tax profit margin, and earnings per share all exceeded expectations. I did think it was interesting that he noted that the shopping experience he thought TJX stores provided were treasure hunt shopping experiences, because that's how I feel when I do go there, but I do love shopping there, just browsing the different aisles. And then based on Q3 outperformance, they did decide to raise guidance for the sales, pre-tax profit margin, and EPS guidance. So guidance is, to kind of explain, is when like a company is kind of giving their expectations of what they believe they can do for the full year that year. So they'll guide like at the end of the year for the next year, but then like each quarter kind of like saying like, we're maintaining expectations. We think that we'll hit this number. Or if they're hitting numbers lower than what they expected, they might guide down. You'll hear people say in terms of like they're lowering their expectations. Or if they see from performance within the quarter that they're doing a lot better, they might guide up, which is saying that they think that they're doing a lot better in their guidance, so they're revising their expectations to be higher. Again, these are all expectations, so nothing's really finalized. And you'll see like in the statements like this disclosure of forward-looking statements, blah, blah, blah. But they think that since they did so well in Q3 that they are actually going to do better for full year, so they're raising their guidance upwards for sales, profit, pre-tax profit margin, and then earnings per share or EPS. In terms of sales by division, I calculated these numbers. I just thought it was kind of interesting to look at in terms of different splits. So Marmaxx is a division for TJ.Maxx, Marshalls, and Sierra. That was 59.78% of the net sales. For the quarter, HomeGoods, which is comprised of HomeGoods and HomeSense, was 16.8% of net sales. TJX Canada was 9.87% of net sales. And TJX International was 13.55% of net sales. Interesting note here, a couple years ago I was in London with my mom, and while we were there, saw a TJ.Maxx, which we of course browsed through, but I was not expecting to see a TJ.Maxx and Marshalls in London. So it was interesting to see there. So moving on from the net sales by division, for margins, pre-tax profit margin was 12.7%. As previously stated, that was above their prior guidance for the quarter. And this was also 40 basis points above their performance last year. For gross profit margins, it was 32.6%, which is actually up 100 basis points from last year. So this is a whole percentage point. And they're saying this was due to higher merchandise margins. And then they later on specifically stated that they did experience lower freight costs. And then I do believe this lower freight cost to play into the next point, which is inventory. They said total inventory was up $1 billion from Q3 fiscal year 2025. And they specifically did point out that they had terrific buying opportunities. I do think those terrific buying opportunities, that they saw a lot of products on the market that they believe could align with their customers and what they wanted, but then also they had experienced lower freight costs that could also contributed to them buying more and increasing their inventory levels that way. Because it doesn't sound like they're concerned about their inventory levels in terms of selling it. It just means that maybe they wanted to stock up while they could and had this opportunity. Again, I do think the freight costs may have contributed to that. In terms of cash and shareholder distribution, they repurchased 4.2 million of TJX stock for $594 million and then paid out dividends of $472 million during Q3. And then for the full year, they do expect to repurchase a total of $2.5 billion stock for throughout the year. Moving on from TJX, we're going on to Target. I do want to say from Target, it really does look like the protests that they've been having by different movements has really impacted them. So you see here, like for Q3 2025, sales were 1.5% lower than Q3 2024. And then you especially do see this where they say like their earnings per share for Q3 25 was $1.51 compared to $1.85 from last year Q3 24 sales. So that definitely is showing like how their sales have been lower this year. For digital comparable sales, they did see a growth of 2.4%, and they did say this is primarily driven by 35% growth in same-day delivery services from Target Circle 360. I do think in general you're starting to see with these stores, because we'll also talk about with Walmart, where their memberships are providing additional income for them and actually providing a source of growth for them in terms of like delivery, anything that they can add more convenience to the consumer, it looks like, is helping to drive in terms of additional income for them. So comparable store sales did decline 3.8% from last year, it looks like. This is something that we do talk about inventory. I am kind of like, I don't want to say concerned about with Target. This is something I want to look at for when they release their earnings for next year or for next quarter, where they state for this holiday season, they plan on offering 20,000 new items, which is twice as many as last year. Target, I can't remember if it's last year or a previous year, where they really struggle with their having additional inventory in hand and not being able to really sell it. And I get it that they want to offer consumers a choice this holiday season in terms of additional products to buy or just having more additional supply of things that the consumer could buy. But I do also wonder like if this is reintroducing an inventory issue for them in future quarters, just based off of the like prior experience that they had. Moving on to that, but kind of similar, they did say that for gross margin for Q3 25 was 28.2% compared to 28.3% last year, so that's a slight decline. And they know that the slight decline was due to pressures from markdowns, but they did have a growth in advertising and other revenue, and then also additional, they had efficiency gains in supply chain and digital fulfillment. So that's what I'm just saying. Like they already had like some pressure from markdowns this quarter. I wonder if the additional new styles or items will add additional markdown pressure for them. So moving on from there, they did pay out $518 million in dividends for Q3 compared to $516 million from last year. So it's a slight increase. And they did note that because there was overall less shares, there was a 1.8% increase in dividend per share this quarter. In addition to the dividends, they also repurchased 152 million shares during the quarter. So moving on from Target, we're moving on to their competitor, Walmart. Walmart, it did seem like had a good quarter. They adjusted guidance upwards on net sales and adjusted operating income. Their total revenues increased by 6%. Global e-commerce net sales grew by 27%. So this whole, I'm really surprised to see how, for both Walmart and it seems for Target, like in terms of e-commerce, it's really interesting to see how like e-commerce isn't something new, but it seems as though like e-commerce numbers continue to rise. And I do wonder like if, we'll get later on to like the numbers for grocery, but like if e-commerce, I guess people saw how convenient buying online was during COVID, and maybe I guess more and more each day they were realizing, well, you know what, like online, I can just buy online. Like I can delegate buying groceries online. Like someone can deliver that to me because it's more convenient. I just wonder if that's what's driving continual e-commerce growth. So moving on from there, and again, we'll touch on it later when we talk about grocery for Walmart, but going back to this point about memberships, so they saw that membership and other income grew by 9%, which was driven by a 17% global growth and membership fee income, and like for them, that's Walmart Plus. Their adjusted earnings per share for the quarter was $0.62, which is an increase of 6.9%. They repurchased $800 million in stock, so they did give the calculation for that, and it's 7.9 million shares at an average price of 101.57 cents per share. I don't know why I said that weird. $101.57. There you go. So Walmart US, they in their presentation stated broad-based share gains across income brackets led by upper income households. So this is me speculating here, and I couldn't really get the numbers from this, and I could be totally wrong. I'm just really curious to see how American Express's collaboration with Walmart offering the Walmart Plus as a benefit on the Platinum card could potentially be introducing upper income households to them. Specifically, I know the credit card enthusiasts or hobbyists make fun of Platinum Card for being a coupon book, and how Walmart Plus makes no sense for being a benefit for them. But I do wonder if that's actually helping Walmart with their upper income household like penetration rate, because like I've talked to some people where like for them Walmart Plus was a convenient way to get grocery delivery compared to like the supermarket or like I guess Instacart, you would say. They just found like Walmart Walmart Plus to be convenient for them and better. And then also I guess like if Walmart Plus is competing against like Amazon Prime in that sense in terms of like getting other things delivered to them, the Platinum offering to cover, I forget the right word you would say, like to supplement or to the Platinum to like pay the price of, or like to supplement the price of like the membership for it, could really be like helping them bring in consumers from this income bracket per se. And again, it goes through this whole like convenience factor of if I don't have to go grocery shopping, it helps. So again, they said that membership and other income increased by 7.6% with double-digit growth in Walmart Plus fee income. So Walmart Plus is really taking off, it seems. They had a gross profit rate of 27.6%, which was up 19 basis points from last quarter this year, or Q3 2025, there we go, fiscal year. They did see headwinds within the product mix, but they did say that grocery and health and wellness outgrew general merchandise. Specifically for grocery, they had low single-digit growth, but they did see this was led by fresh food sales. E-commerce was up double digits, so again, it seems like people are turning to e-commerce for grocery delivery. And this is an interesting point. They saw for like inflation from Q3 2025 fiscal year was up 1.3%, but from last quarter, so Q2 fiscal year 2026, it was actually 20 basis points lower. So going to the Fed, this is saying that like, okay, so inflation is up from year over year last year. However, within food, at least at Walmart, they're saying there was a bit disinflation compared to last quarter, but 20 basis points like slightly disinflation. Health and wellness, they said, was up low double digits. For general merchandise, they saw low single-digit growth. Sales did strengthen in fashion, home, and auto care. For fashion, I am really curious. I do know like Target has been like advertising their fashion, and Target also has been like, I think, more well known within like people loving their stuff, but Walmart has really been pushing their fashion ads, I feel like, because I've been getting a few of their stuff, and I've even seen like some things where like they try to like get influencers to kind of say like what they've bought from Walmart fashion wise. So I do think Walmart is trying to push in their fashion content, or at least online somehow. For inflation, inflation, they did see was up 1.7% compared to Q2 fiscal year 2025. So this was like kind of interesting because it's completely opposite to grocery, where they did see this was 200 basis points higher than Q2 2026. So they're saying that like not only is it up compared to last year, like it's up a lot from like the prior quarter as well. For marketplace categories, it includes, I don't know what their hardlines product is, and so that's my fault, but they saw hardlines, apparel, electronics, and toys, I guess it's a collective, grow by 40%. Now, again, with not including this hardlines, just because I don't know what this means, but apparel, electronics, and toys are all like hot categories for the holidays. So I'm really curious to see like what this marketplace category will look like next quarter when they do report, since like if they have a good performance next quarter, these are all good things that like consumers are going to be looking for like during the holiday season. Moving on to Sam's Club US, net sales for that entity was up 3.1%. E-commerce, again, big numbers, was up 22%. Sales growth was led by grocery and general merchandise. They saw their membership income increase by 7.1%. This was driven by an increase in selling of memberships. It seems like just off the wording of this, it also was like due to like, I guess people or members who had maybe a lower membership price initially when they signed up, but then they had like a higher renewal membership rate. And then also for Plus members, they said gross profit rate was 11.7%, which is up 10 basis points. Inventory was also up 6% for strategic initiatives, but they did say that their inventory like ratios did remain healthy. So it does seem like Sam's Club in this instance, Sam's Club US in this instance, and TJX are potentially saying the same things. I do think this is something I'm going to like look into further to see if this is something where like maybe retailers are seeing opportunities within logistic pricing to pull forward purchases that they would have made in like Q4 into Q3 just because they know that they can sell it. And then also because like if they are getting logistic prices like that are opportunistic or beneficial to them, they're okay with having that higher inventory on their balance sheets for the quarter just because they know that like they're going to sell it. Target again does kind of seem different in that like they did have like markdown pressure already, but I do wonder like in terms of like freight or other like logistics, like what's going on where companies are saying where it's okay for increase in inventory just because they think it'll work out for them in the future. But that was today's episode. Some common themes it seems are inventory again, maybe some opportunistic pricing for logistics, just based off of Sam's Club US and TJX numbers. E-commerce does seem to be booming with both Target and Walmart talking about that. Also, membership income seems to be booming based off of Target and Walmart earnings. Inflation is another thing to keep a look on as based off of the Fed FOMC Meeting Minutes. But yeah, I think that's mostly everything from this podcast. Let me know in the comments below like what you thought about today's episode, any interesting points that you wanted to add to the discussion. I'm recording this on Monday, November 24th, the Monday before Thanksgiving. So if you're in the US and you're celebrating, happy Thanksgiving to you and yours. But looking forward to seeing you next week. Bye.